Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about, or we are going to be exploring the ADX Reversal Strategy, a systematic approach to identifying trend exhaustion and market reversal. You will learn how to spot potential reversals and execute trade using the ADX indicator. The ADX indicator is also called the Average Directional Index. Now let's understand the basics of this indicator. The ADX indicator consists of three lines. The three lines, which the main line is the ADX line, typically a black, or in this case a yellow line. Let me set it to a black line to make it easier for you. The ADX line is usually a black line, while the second line over there is the plus DI line, which is usually a green line on the chart. As you can see, the plus D1 line is the green line on the chart. The third line we have there is the minus DI line, which is a red line on the chart. When you see the ADX line above 25, you are in a strong trend, and when it's below 20, you are in a your market is lacking direction and you might be preparing for a reversal. I repeat, when the ADX, which is this black line, when it is above 25, you are in a strong trend. When it's above 25, you are in a strong trend, and once it's below 20, it means that the market lacks direction and you might be preparing for a reversal. Your first reversal signal appears when the ADX reaches the extreme level. Watch out for readings between 50 and 60, as they often mark the start of a strong trend. At these levels, even the strong trends needs to take a breather. Here is where it gets interesting. We also look for divergence between the price and the ADX. If price makes a series of higher highs and the ADX make a series of lower highs, you have spot a potential reversal setup. As we can see from here on the price, you can see that the price made series of higher high. Then when we look at the ADX, indicator, we can see that the ADX made a series of lower high, showing that this is a potential reversal area. We are going to expect a reversal once we see a divergence. The final piece comes in from the DI line. When the plus DI crosses above the minus DI, once the plus D crosses above the minus DI, that's your buy signal. The opposite is true for selling signal. So the opposite would be when the minus D line crosses over the positive D line. It signals a selling signal. The crossover works best when the ADX is starting to rise from below 25. Now that you understand these signals, let's see how we can put everything together in an actual trade. Now, how do we set up our trade? For trading setup, we use the ADX reversal strategy. It is important to follow clear entry rules. First, wait for the ADX to cross above. First of all, you wait for the ADX to cross above 25. Once the ADX crosses above 25, it signals that there is a strong trend at this area. Once it crosses above 25, you notice that there is a strong trend in that area. This indicates that there is a strong trend forming, which is essential for your strategy. Next, you look for the crossover between the plus DI and the minus DI. If the DI the plus DI crosses above the minus DI, this signals buying opportunity. As we can see, when the positive DI, which is this green line, crosses above the negative D line, it shows that we are looking for buying opportunities. Conversely, if the minus D line crosses below, once the minus D line crosses below the positive D line, it signals selling opportunity. This crossover should happen when the ADX is rising. Once you identify these signals, you place your order just 1 pip beyond the signal candle. So in this buying opportunity, when we spot that the ADX is above 25 and our positive DI line is above our negative D line, and the moment we spot this confluence all together, we take our trade 1 pip or 2 pips beyond the candle. This helps ensure that you entered after the market confirms the move. Don't forget, risk management is crucial in any trading strategy. Set your stop loss to 2 to 5 pips beyond the entry candle. 2 to 5 pips beyond the entry candle. This protects your capital in case of market moves against you. Then let's not forget that our take profit, we aim for a risk to reward of at least 3 times your risk, meaning that if you are risking 5 pips or you are risking 20 pips of your account, you are going to be able to target at least 60 or 40 pips, meaning 1:2 or 1:3, as the case may be. The ratio helps you to ensure that even with some losing trades, you can still be a profitable overall trader. With this setup in mind, you will be ready to enter trade confidently. Next, we will reveal a real trading example to see how this principle can become into play. Now, let's look for an example where we can put this into play. At this area in the market, as we can see in this area in the market, the ADX line is above 25. At this area, it's trading above 25, and we notice that our positive DI line is above our negative DI line, meaning it's an opportunity to enter the market, and we'll enter after our confirmation candle. We put our stop loss just below the candle. When we put it just below the candle, we aim for 1:2 or 1:3, as the case may be. Now, there are some common mistakes to avoid. Let's look at 3 critical mistakes traders make while trading the ADX reversal strategy. The first mistake is trading when the ADX is reading below 20. Do not trade when the ADX is reading below 20. That's the first mistake a trader can make. This indicates a weak trend leading to a choppy price action and a false signal. As you can see at this area of the market, the ADX was trading below 25, showing that it was a sideways moving market. As you can see, the market was moving sideways in this area. The second mistake is ignoring price action. Never enter a trade solely on the ADX and the DI crossover. You have to wait for a clear candlestick pattern or a break of structure to confirm your entry. If you do not confirm your entry using the break of structure, you might end up taking a losing trade. Now, the third mistake you need to avoid, the third and the most costly mistake, is missing divergence signal. Missing divergence signal. When the price make a new higher high but the ADX makes a lower high, many traders still enter the trend and feel that the trade is ready to reverse. Like I said, when price make a new high but the ADX makes a lower high, it is a sign that the price might be preparing, it might be a fake out. That is what he's trying to say. Let me give you an example. An example from the charts. Let's look for an example to make us understand this. As we can see from this example, when price made a higher high and the ADX indicator made a lower low, we should not ignore such signals because they might be telling us that the market might be ready or preparing to make a reversal. So when we see a divergence, do not forget to not ignore this signal because it's trying to tell us what the market makers are trying to do. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. So thank you for watching and I will see you in the next video.